This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
This show is going to address one of the comments left by a viewer, and thank you for the comments, everyone. But first, I want to give a big thank you to listener Jay Brando Porter for having the idea to get rid of the spammer in the comment section that I think I talk about every show. So, Jay, we're looking into it right now, so thank you very much. Now, back to the comment. Ballai Mustafa writes, I'm one of Andy's fortunate students in the Cashflow Academy. With the economy in uncertain territory, an unimpending market crash is likely. It would be great for Andy to teach us his top 3 trading, not investing, but trading strategies he and his mentors use when markets are tanking and the volatility is extremely high. So to discover from Rich Dad advisor Andy Tanner himself his top 3 trading strategies, Andy, welcome back to the show.
Hey, Greg, thanks. I'm excited for this one. And again, I thank you for the comment listening there. I love all the students in the Cashflow Academy, and great to hear from them.
Very cool. We're actually getting quite a lot of comments, quite a lot of questions. So I've got a whole bunch to throw your way, but we'll do that later.
Cool. Let's hop in.
All right. What is your number one trading strategy? Yes.
Well, let's build context first. I know. Everyone wants, give me the fish, quit dangling stuff. So, I often seize the opportunity to talk about education versus advice. And I think it'd be wise to frame that this way. One of the things I'm concerned about, particularly after the GameStop debacle, is that people will go to Reddit or YouTube or podcast or a statement Andy made and says, well, Andy says he likes this, and they just go crazy without any background or any education or any paper trading or any experience or practice. And so I'll just say that if I were, to ask, if you're asking my favorite, that's probably different than what I tell my mom to do. So that's important to understand that just because Andy likes them, that doesn't necessarily mean that they're appropriate for everybody. And as I list these strategies, I list them in the idea that someone says, okay, that's something I want to learn about, as opposed to, oh, I think I'll try that.
Okay. So what you're saying is, yeah, like you can have these strategies because you're extremely educated and extremely experienced. Whereas if I was to try to do those strategy, I'd probably get burned because I need to start a little simpler and get educated before I attempt this.
Well, whenever we go on a cruise ship, they take a moment and you go to a muster station and you practice putting on the vest, and you have a strategy if things go wrong. Whenever you get on an airplane, they have a little talk before you take off about what happens if it goes wrong. And so every single one of these strategies can fail. Every single one can lose. Everyone has risk. So I know I don't want to be a Danny Downer, or what do they call it, or party pooper, but or what is it, Debbie Downer? I don't know what they call it, but whatever it is.
Nowadays, it's called being a Karen.
Yeah, So I would hate anyone to lose a dime by being flippant and going out. So that's a little bit of a disclaimer. So, and he said trading, not investing. I have to throw in one that can be both. Because you can buy a stock and have it for a long, long time as an investor. You can buy a stock and sell it tomorrow. So this one can be investing or trading, and I tend to do it more kind of as depending on how it works out. It could be either. I might say, this is a trade, or I might say, that could be an investment. So as my favorite strategy, I think dealing with options when volatility is higher. He mentioned volatility being high. When volatility is high, that means insurance premiums, option premiums are richer. And so, when volatility goes up, we seek opportunity from that. We really, really do. So a person might think of their insurance company and they think, well, I have this, car insurance. And, if you've never broken the speed limit and then you've put one of those little safe driver discount monitors that show how you drive and don't mess with my discount, you'll get better insurance premiums. If you don't have those things and you have speeding tickets and a DUI here and there, it's going to go up higher. So when there's volatility in the market, options are more expensive because options give people guarantees. They give people absolute guarantees of where they can buy something and where they can sell something. Those guarantees aren't free. When the market's volatile, they're certainly not cheap. So this will be no surprise to any student of the Cash Flow Academy or anyone that's seen any of our webinars we'll do from time to time. Probably my favorite strategy for both investing and trading is selling puts for premium by making promises to buy stocks at prices that I find attractive. And we call that a cash covered put. Some people call it a naked put, but it's really, I do it cash covered because I always have the cash to keep the promise. So let me explain what that means. And I'll use an example. Actually, I have one right now that's a good example. I don't know that we have the highest volatility. Let's just check both of them here. I can pop open a little chart of that too. Let's look at I'll just look at this on my computer here. And let's just look at the volatility index right now, the VIX. And the VIX today, it's right around it's just above 20. Got a little floor at 20. Pre-coronavirus, we're down, 10 or 11-ish. So it's about twice what it was a year ago. So there's twice as much fear right now with economy and, volatility as there been. We've had, really 5 major spikes in volatility since the coronavirus of March of 2020.
Can I interrupt you real quick?
Yeah.
You're using volatility to measure fear?
Yeah, we've talked about that. We call it the fear gauge, right? If a person buys insurance, it's because they're afraid that they'll get sick, or they're afraid their house will burn down, or they're afraid they'll get their car wrecked, they're afraid they'll get cancer, whatever. So insurance is really to address fears of the unknown. And so when you look at the volatility index, it just says, hey, what are people paying to buy puts on the S&P 500 stocks? What are they paying? And if there's a lot of demand for that and a lot of volatility, they're going to pay more. So right now, to insure your S&P 500 stocks, so to speak, you're paying twice as much today as you were a year ago. So that's it. So that starts me by saying, well, look, that means maybe I want to be a seller of insurance, if I feel good. And the difference between selling option and insurance, Greg, is that often when insurance companies make promises, they're not excited about keeping them. My parents had an unfortunate auto accident, and the insurance wasn't excited about, paying all that we felt, needed to be paid. And so, that's when attorneys get involved and all that type of stuff. And so, insurance companies aren't thrilled with claims. Option traders actually can be quite excited. So I'll give you an example. You've heard of Snowflake. That was an IPO recent. You heard of that one?
Yep, right.
Yeah, big in the news, and made a big deal of the IPO. I had I like the idea of having exposure to Snowflake through Berkshire Hathaway because they bought it pre-IPO. They got in on the ground floor. So if you own some Berkshire, you've already got some exposure to that company by owning it. But I didn't buy into the IPO because those are volatile and uncertain. But now the stock, as of this moment, is around $300 a share. So it's done very, very well. It's pretty popular stock. Well, I looked at it when it came out, after all the hubbub, you could have bought it about 210. So in hindsight, should I have bought it? It doesn't bother me that I didn't. But if I bought it at 210, I'd be up almost $90 to $100 right now. So there was some volatility in Snowflake, and it was kind of dropping down a little bit. And for $1, this is pretty cheap. For $100 a contract, you could do 110, however many you wanted. But you get $100 if you promise to buy 100 shares at 210. So that's like a third cheaper, right? It would have to fall. This one expires tomorrow, 19th of February. So I made a promise to buy Snowflake at 210 at the original price that was kind of out there at the beginning. I says, all right, it's got some history on it now. I've seen where the stock has settled in. You want to give it to me at 210? I'll buy it from you. So I have my cash ready to buy this at 210. Now, if that went down below 210, I'd be obligated to buy it, and I'd be happy to do it. And that would become, at that point, an investment, wouldn't it? It'd become shares that I own, and I'd be more than happy to pay 210. If it went to 190, 180, I'd say, well, you know what? I'm thinking that it's probably worth 210 to me. It's certainly worth 300 today. I'd be happy to pay 210. And if it fell down from that point, it'd just be like owning the stock. Well, they'll pay me $100 for every contract I engage in. So every time I make that promise, I get paid $100. And that will expire 19th of February. So there you have it. It's $100 in the pocket. The odds right now of it getting to 210 are extremely low. So in my mind, this is really a trade. I really don't have a lot of confidence that Snowflake's going to get down to 210 by the time this option expires. So while I'm kind of playing both sides of the fence, I'm really looking at this as a trade because I don't think it's going to get down there. But if it did and it turned into investment, wouldn't hurt my feelings. I mean, if you could buy Snowflake, it's at 300 right now. If you could buy it at 210 today, would you take that?
Absolutely.
What if I paid you $100 to do it? Would you be okay with that?
Absolutely.
So there's not just in volatile times, but most times I could look in my portfolio right here and find a couple of positions like that. And I keep them pretty small. I don't go nuts on it because if you have several of those across several stocks, great. And if one of them does happen to have a problem and you're lucky enough to get paid to buy it at that low price, great. What I really love about it is Snowflake went up and I still get that $100. So whether it goes up, down, sideways, backwards, forwards, whatever, that $100 is mine for good. And the chances of me keeping that promise are very, very low. So here's what's really cool. When coronavirus hit, in like the student said, what happens when it's falling and it's crazy? When coronavirus hit, I got pretty excited. And while Warren Buffett said, well, I'm going to sell my Delta, I said, well, I'll buy it if it gets low enough. Right? If it gets low enough, I'll buy it. That's one of the ones in 2020. It was kind of a win for me because I was able to get paid to buy that low.
Right.
And, it's creeped back up is hope for, I think it'll be big because there's so much pent up. How many people do you know that as soon as they lift restrictions, they're going to Hawaii? I know I am.
Yeah, I already booked my ticket.
So, yeah, I think there'll be some pent up demand there for sure. So that's one of my favorite things to do because in the middle of coronavirus, there's so much volatility that those premiums, you can get paid a lot of money. And so let's say that there was an event, coronavirus, it could be an economic event, bad GDP, a company specific event like Kraft Heinz had some impairment costs, FTC's after them for jacking up their brand equity too high. All those things can happen. And when that happens and the stock becomes volatile, I say to myself, well, what price would I be happy with? If I could get a killer discount, what price would I love to buy that at? And then I'll see how much they're offering. I'll see how much the premium is. So that would be number one, is the naked put. I love to use that time to acquire stocks, and it can be an investment and a trade, because if you're wrong and the stock goes up, then great, you keep the premium and you never had to buy at the low, at the low price, or got to buy at the low price. It goes down, great, then you pick up some more shares as an investment. So it's kind of both a trade and an investment.
So that makes you happy when you only do it on stocks that you want to buy anyways, that you check the fundamentals on and you find the stock itself valuable at that point.
Absolutely. It's less of a speculative trade and more of I'm willing to trade it. But if it did fall down low enough, I wouldn't mind owning it either. So I'm kind of playing both sides of it. So I think that qualifies both of the trading strategy, but also a way to acquire stocks. Most of the classes I teach, I'd say 90% of them, when I do a web class, I use an example of Warren Buffett doing that with Coca-Cola,
right?
Where he says, look, I'd be happy to buy this low. So that's number one.
All right.
Number one. Number two, you ready?
I'm ready.
Number two, it'd just be buy put. And that's more speculation. If I buy a put, I'm going to do a little bit longer term because of time decay. I'll usually buy my puts 2 months or more, 3 months out.
Is there a limit on how far out you can buy them?
Yeah, but it's pretty far. There's something called the LEAPS, stands for long-term equity anticipation security, which is basically a fancy name for a long-term option. So you can go out a couple years on these,
Okay.
2-3 years in some cases. They're usually longer than 8 months. But I like that 3 month or longer sweet spot because my time decay is slower. And if it doesn't happen, I can often, get out, sell the put I bought and not lose as much. I'll have lost some. depending on where the stock went. But the time doesn't hurt me as much. The time decay doesn't hurt me. And there's a lot of reasons for the put that I guess we could talk about a little later when we talk about why not short. But the nice thing about a put is that it has defined risk. In other words, the maximum risk is the premium I paid. And that's the most I can possibly lose if I'm wrong. And so those positions are generally small. There's a feeling of greed that happens. I used to feel this a lot more than I do now. I imagine I'll always feel it. Everyone has a greed gland inside. But I hope that my temperament as an old man now, having lost so much money doing this over the years in mistakes as a young man, I hope my temperament now is not one of freaking out and of, they call it FOMO, the fear of missing out. Oh, something's GameStop, something's going on. Say, oh, Snowflake's having an IPO. I don't want to miss on it. And I just kind of said, look, Andy, you have some stocks. You have the ability to write calls on them. You have a strategy, you get dividends. If you stay consistent, when you're older and you got a long white beard, then maybe I can do something, and have some pride in what we accomplished, when I'm Buffett's age, or Munger's age. But I also love to dabble when stuff like this goes on and do some trades, but I keep those positions small and I keep them within reason and, go to Vegas and have a little fun. So buying a put, very simple. And all a put is gives me the right to sell something high, even if it goes down low. And that's important. Should we explain that a little bit?
Yeah. I would like help. And before you get into what a put is, we did talk about options and time decay. When let's say you did a 3-month option, can you sell that at any time before the 3 months?
Yeah, they're just like stocks. They're generally very liquid. There's a bid and ask price for them. And so if the value of that option is not increasing like I'd like it to, I could put in what's called a stop order and say, look, I'm going to pay $5 for this option. And if it doesn't go the right way and the value of that option gets down to $3.50, I want out. And so I'd lose $1.50. The most I could lose is the premium paid $5 if I hold it till expiration and it doesn't go that way. For me, I generally don't like to do that. I like to buy enough time that if it doesn't move the right way, there'll still be something in there I can get back if I get rid of it.
Okay. So
that's that. Making, you have someone's guarantee to sell. Mark Cuban made a lot of money on Yahoo this way. It's a great way to use his insurance, not just to trade, right? If you have something you want to insure. And Mark Cuban, I think Yahoo stock, he had, $6 billion of Yahoo stock. He sold his broadcast company, something like that. I don't remember the figure. It was billions. And it was around $200 a share and it dropped like $5. And I was like, well, how are you still a billionaire if your stock got killed? And he said, well, I was hedged, I was covered. And so he had the right to sell it, let's say at 200, even though it's only worth 5. Well, that's pretty cool because if I just buy a put without owning the stock and I have the right to sell, let's say Snowflake at 300 and it goes to 2, I can now buy Snowflake and sell it at 3 because I have a guarantee to do it. So I actually never have to touch the stock. It's called intrinsic value. So just the power to be able to do that allows me to sell that option for the intrinsic value that it gained in that drop. So I don't do a lot of that. Is it one of my favorite things to do? Yeah, but again, I don't do a lot of it. The question was, what are your favorite when you do it?
Right.
There again, I sound like a beer commercial, Cerveza commercial, saying, well, I don't often buy puts. When I do, it's when there's high volatility and the market's dropping. You do pay a lot more for those puts, but sometimes it's worth that premium to do that. A good example of that is I'm down a little bit on my stock position on ExxonMobil. But if you look at during that period, I also bought some puts on ExxonMobil. And so while I'm down in the stock, I got compensated by the put option I bought. So my actual cost basis isn't near as bad as it would look on my statement today, because you got to realize, he made thousands of dollars on that put option as it went down, right?
Right,
so
right. That's why you call it
So,
insurance.
yeah, and I've lost money doing this, no question. There's speculation. We're talking about trading and investing, lose money. I bought puts that have lost money before, no question. That's why it's important to keep those position sizes small and reasonable and understand these are trades. These are not things you're staking your life on.
Gotcha.
So I love the put, and the reason I love the put is it's simple, straightforward. It's one purchase, and there's a limit. Most important is there's a limit to the amount of money I can lose. The amount of loss is limited to the premium I paid.
Right. You're always talking about risk management.
The risk is finite, and so you can lose 100% of the money you put in, but you can lose no more than that. And with the leverage, you don't like shorting a stock, short 100 shares or buy one put. Buy one put's a lot less money at risk, and you have a finite amount that you can lose. And if you keep your position size reasonable, if it doesn't work out, you say, darn it, didn't work out. It doesn't kill what you're trying to do.
Right.
So
Okay.
that would be numbered. So number one would be selling the cash covered put, hoping to acquire something cheap for a fat premium up front. The second would be buying a put.
All right. So that leaves us to number 3. And then I think you have a fourth.
Yeah. Third is a tie. Third is a tie between what's called something called a ratio spread, or you could not do a ratio and do what's called a credit spread. And in coronavirus, one of the things that we did, we had every year, in fact, it's coming up. I'll probably do it in April, maybe March. It's usually March or April I do it. Every year I do something called a Quick Start Lab. And what the Quick Start Lab is my lead risk manager, coaching trainer, Corey Halliday, and we do like a power month where we do 2 sets. It's live, right? Everyone can come in, ask their questions live. And we trade live, whatever the market is, we just trade it and we look at it and we say, let's take, like this viewer asked, what are the favorite strategies you have? And last year we do 2 a month, or we do two sessions a week for 1 month. So 8 sessions in 4 weeks, basically. They're a couple hours each. They usually do them at night. It's a lot of fun.
Is this for your students only, or is this open to?
Yeah, it's exclusive for students. We call it our Quick Start Labs. We have a lot of people enrolled. And we just do it once a year, and we record them, and they get access like the last, 8 years worth, however long we've done it. Anyway, last year, it just so happened to work out, and I was mortified because coronavirus last March, a year ago, it was the worst drop we've had in the market in history.
Right.
I mean, it was, but in a way, it was like shooting fish in a barrel because it was so much fear. You just boom. And one of the strategies we used there, and in fact, we did this on gold, on GLD, on the ETF, is we did a credit spread where we'd say, look, we'll sell a call and get paid on the call. And as it drops, that call becomes worthless. But just in case we're wrong and it spikes, we'll buy a call up here. And so that's why they call it a spread, is you get the difference between the money you received for selling your call and the money you bought for buying a call. And because they're what we call different strike prices, your risk is limited to whatever the difference is. So here's an example. Let's say their stock ABC and it's $100 a share and trouble hits and I think it's going to go down. I might say, well, I'll sell a call at 120 and I'll buy a call at 125. Now my risk is $5. Whatever I get in that premium is my profit, called the spread, and it's a credit. It's not something I get if the stock moves. I get it up front. It's a credit trade. I push a button and money is deposited in that account immediately. And now I'm accountable for the promises I've made, but I also have in my pocket the promises I've purchased, the options that I have. And as that goes down, both options expire worthless, the one I bought and the one I sold, but the one we've sold was worth more. And so, we make that money. And that's a very easy way to do that with, again, a fixed risk, betting something's going down. It's one of my favorite trades. I've done a lot of those. Some people have heard a fancy word called an iron condor. It's the upper half of an iron condor, basically. And then you can also do a ratio spread, which is a little more complex, where they're uneven in the number of contracts, but it can really benefit you if it moves either way. It's a little safer on moves both ways, but if it stays the same, you really get killed.
Wow, gotcha.
So there's a lot of strategies. To narrow it down to 3 is tough. But I would say that and I don't know that it's important for people here. Like if you say, if you went to a doctor and say, what's your favorite surgery? He says, well, it's to reattach the chordae tendineae to the bicuspid valve. And they say, well, shoot, I think I'll go do that. Maybe they think, well, that sounds interesting. Let me learn about it. So I'm less concerned. Robert is adamant about big picture, number one. Don't get mired in detail. And vocabulary is huge. You start talking about stuff people don't understand, they tune out. And if someone wants to tune out, that's fine. They can tune out. But what I would hope is someone would say, okay, those are three strategies. I'm curious. That's different than what I've heard about. I'd like to learn those. And I'd like to practice those in a paper trade account, risk-free, which I demand from new students. And then I learn how it works. And then I might say, maybe I'll try a little one and get a little more real experience. And you grow from there. Would maybe be one way you could approach it with your team of advisors.
So in your courses, you teach all three of these?
You bet. Yeah, we do. Yeah.
So last question, and then we'll close this up. But Robert always says, you make more money when it's volatile. Is that because it means everyone's afraid, and if you have emotional intelligence, you're not afraid, and you can see it for what it is? And
I think, well, part of that for sure. Part of it is like Kenny has nerves of steel. Kenny's fearless. Kenny doesn't even bat an eye at risk.
Kenny is the rich dad advisor for real estate.
When Robert says this in real estate and stocks, they're a little bit easier to do in stocks and real estate. When he says we make more money in a real estate crash, what that means is there's bargains to be had, right? I mean, Kenny's done this. I've seen him do it twice. I think he's getting ready to do it a third time. He's predicting the real estate to really pull back after a nice, 10-year run or 12 years, whatever it's been. And when it pulls back, he will pounce. He will buy up a lot of, you look at the hotels right now, there's going to be some beachfront hotels for sale because coronavirus kills the lodging industry, right?
Yeah, absolutely.
There'll be some commercial real estate available because Amazon's taking them out and coronavirus. That's a double whammy. So he's ready to pounce. When they say we make more money when the market crashes, that's true because they're going to pounce. Now, with stocks, a little different. That's absolutely true too. I love to look for bargains when there's a pullback, right? But I can also make money by getting paid for that pullback, even if it doesn't happen, by selling the put that I mentioned. I can make money on the downside as it happens by buying puts. And I can also do it with credit spreads and a dozen other different ways, you can do it. The one that we probably would end on that I would mention that I don't do very often, I haven't done it because I have, and I do, but very rarely. And if I do, very small, is to take short positions. And the reason is a short position has unlimited risk. You'll notice I made a big deal when I talked about puts that it was a fixed amount. Maximum risk is premium paid. Well, if I short a stock, it's $100 a share. That means I borrowed a share from the brokerage and sold it for $100. So now I have a $100 bill, but I owe the brokerage a share.
Right.
What if that share goes to $600, $700, $800, $1,000, and the broker says, I want my shares back? Then I would have to take that $100 bill and 900 more out of my own pocket to buy that $1,000 stock and give it back to the brokerage. And that's how the hedge funds, as we talked about GameStop, that's how they got crushed. Is the broker said, hey, we want to make sure you can give us back our stock. You either have to deposit more money to prove you can pay for it, or we're just going to liquidate. And if you gamble with that, you say, well, maybe it'll come back down. You deposit more money, and maybe it comes down, deposit more money, and it doesn't come back down. You can't deposit more money because you're cleaned out. It's kind of like being in Vegas when you hit the table limit. There's something called martingaling where you just double down, then it hits and you get your money back. That's why there's a table limit. There's a limit to how many times you can double down. Well, in the stock market, your limit to doubling down is your bank account size. That's your table limit. Once you get a bank account size and it's all out there, if it doesn't fly, you're going to be like those hedge funds. You're going to get beat up. So shorting is probably my least favorite way to do it. I have shorted stocks before, but it's very, very risky to have an unlimited upside. And, in the case of GameStop, I had a short position on GameStop for a while, and I also had some puts. I bought some puts on GameStop. And when it bottomed out, bottomed out at 2, I think I got out at like 5 or 7. I looked at it like, okay, I got $7 left to bankruptcy, and it's hard to go bankrupt. And something good could happen. They get bought out, new technology. I didn't see the Reddit thing coming. I can't say I saw that coming, but anything can happen. I thought, okay, I got an unlimited upside now where it could go up, very little downside, probably time to close these positions and not have that exposure. That was a couple of years ago. I haven't messed with GameStop there. In our mentor club, we did some option trading, but going short by itself in a volatile time, it's kind of scary because you don't know where the bottom is, and you don't know when that scare will go away and when it'll be settled. And trying to time that, even the best technical analysts can take their guess, and I certainly could take mine, but the chances of being wrong on that are great in a volatile environment. There's a real high chance that, okay, that's the bottom, up it goes. And, look at all these poor GameStop people. Some of them just got crushed on both sides of the trade.
Right.
They're trying to time it, and they're greedy, and they'd have probably been better off just saying, what's my 30-year strategy to be an investor? So I appreciate the question, not investing, but trading. And I think it's okay to do both. We teach both. They're both fun to do. I think it's wise to really have a good, solid investing strategy. And then if you're skilled like Noah Davidson, play with some options. So there you go. Cash covered put, long put, credit spread, call credit spread. And then, what we'd call it a bear call spread, credit spread. And then shorting, be careful with that one.
Gotcha. Yeah, I hear a lot of people use shorting and puts like they're the same thing, but the put has limited risk and the shorting has infinite risk. Okay.
That's right. And a put is something, if you're bearish, that you might buy, where shorting is borrowing stock.
Gotcha.
When I buy a put, I bought a contract. I have it. I own it. It's an asset. When I short a stock, I don't own the asset. I borrowed something.
Right.
Leverage. So they are different. The reason they get confused a lot is they're both bearish moves, right? So when someone says the word bearish, the word short have kind of become like Kleenex and tissue, unfortunately. It's kind of the same thing. Whereas they have me a Kleenex, it might not be a Kleenex at all. It might be a tissue. Might not even be a Kleenex, it might be a tissue, right? So when people say, yeah, I'm short, I've done it too. I've said, I'm short GameStop. Well, really, I had long-term equity anticipation securities that were bearish.
Right.
I puts, long-term puts. And I wasn't truly short. I was bearish. So there is a distinction. I'm glad you brought that up. So I hope that's fun. I hope that piques people's curiosity more than anything else, where they would say, gee, I'm not sure what that, credit spread was all about, but if there are ways to capitalize as a trader on this, or even to learn to protect myself, to hedge against stuff that I own. And I love the comment. He says, there could be some pullback here. And I agree. There's a lot of forces that say we could go to the moon, especially with the money that we're planning on printing. And if we do MMT, you're buying stocks. Okay. So there's a lot of bullish pressures,
right? But
there's also a lot of that MMT can fail. The economy can have problems. There's a lot of, as much pent-up demand as there is, there's a lot of business closures too. So being prepared for either scenario as an investor and a trader, that might pique someone's interest to say, these are terms I think I'd like to learn a little bit more about. Gotcha. But hopefully, I don't know if we answered the question well or thoroughly or comprehensively, as you couldn't in a short podcast.
Well, then let's go to that real quick. In the show notes, there's 2 links for Andy, but I really recommend you click on the one for webinars, because that takes you to a page with like 5 different trainings on it. And so the listeners, the viewers, they can pick which training they want. It's free. And hopefully they can better understand these strategies you're talking about, because you do go into much more in depth.
I should know what trainings you've got posted. I thank you for the plug. I'm not sure, but I'll tell you this: chances are one of those has the cash cover put in it. I just teach it so much. It's probably in there. So,
well, thank you, Andy. Thank you for always teaching. Like, you're never selling; you're always teaching, and I think everybody here really appreciates that.
I appreciate you, Greg. Thanks so much, buddy. We'll see you next week.
All right, Andy. Thank you.